We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets.
A runaway AI valuation boom hit a wall as investors abruptly reassessed stretched multiples, triggering a synchronized global sell-off despite blockbuster Nvidia earnings and solid U.S. data. Tech-led weakness dragged the S&P and Nasdaq sharply lower, while Europe's surprisingly resilient PMIs and improving UK inflation were overshadowed by the risk-off mood. In Asia, Japan's massive stimulus package weakened the yen and stoked debt concerns, while China's deepening property downturn hammered equities and revived fears of a broader credit squeeze. The common thread? Sentiment cracked, volatility spiked, and markets entered a more skeptical, valuation-driven phase.
Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
So this was the week. The market's excitement over AI, well, it didn't just fade. It slammed right into a wall of reality. And that drove a really sharp, synchronized pullback pretty much everywhere you looked.
That's it. That narrative shift is the most important thing you need to focus on this week, because you have genuinely blockbuster earnings. Yeah. And yes, we are talking about Nvidia and the economic data. It was surprisingly solid, but none of that was the dominant force. It was this rapid, skeptical reevaluation of what everyone's calling overstretched valuations.
And that shift in psychology, that's everything. So our mission today is to cut through all that noise. We want to show you exactly where the fundamental risks and, the opportunities are hiding after a week like this. We're going region by region, US, Europe, UK, Japan, China. We'll distill the key takeaways, preview a crucial and pretty confusing data calendar for next week, and then we'll hand you the top 5 global risks you absolutely have to monitor. Okay, let's start at the epicenter of it all, the US markets. They took the biggest hit, and it was led, of course, by the big tech names that have driven this whole rally. The S&P 500 closed down 1.94%. The Nasdaq shed a really heavy 2.74%.
And right at the heart of that is the Nvidia paradox. I mean, the chip maker posted record revenue. They confirmed the AI infrastructure build-out is still going strong, and they gave a very, very strong Q4 outlook. This is the kind of news that should validate the entire sector.
And yet the shares closed down 3%. So if the profits are confirming the story, why are investors punishing the stock? Is this just, some knee-jerk profit taking? Or is something more fundamental changing?
It's the latter. And this is the insight you really need. The valuation anxiety, it basically boiled over. The market has already priced in several years of flawless exponential growth. So when investors start to apply a higher discount rate to those 2026 or 2027 earnings, the present value of the stock drops. It drops even if the current quarter is perfect. The fundamentals were just not enough to justify the multiples anymore.
And then you had this mixed labor data compounding the anxiety. We saw 119,000 new jobs added, that's above forecasts, so payrolls are strong. But, and this is the pivot point, unemployment rose to 4.4%. That's the highest it's been since 2021.
Right. And that crack in the labor market basically gave the Fed a license to breathe. You had those dovish comments from New York Fed President John Williams, and then the market just abruptly repriced everything. The odds of a December rate cut went from, maybe 30%, all the way up to around 72% in a single session.
That is a massive swing. And that's usually where people get caught offside. It's like the market went from unlikely to probable in 48 hours. And that instability, that explains the volatility, right? The VIX, the fear gauge, it spiked violently up to 28 before it eased back to 23.
And it's so important to put that move in context. Anything over 25, that signals real fear. That's way outside the normal comfort zone. So the key takeaway from the U.S. is that strong earnings and solid job growth, they just weren't enough. They couldn't offset this deepening skepticism about how much further this AI valuation rally can really run.
Okay, so if the US is obsessed with pricing growth, let's look at Europe.
Okay.
Because that global risk aversion really hit them, even though their own economic story was, paradoxically, a lot better on the ground. European equities followed Wall Street lower, of course. The STOXX 600 dropped 2.21%. But the domestic story was different.
It's a classic example of the global herd overriding local fundamentals. The Eurozone composite PMI, it came in at 52.4. That's a clear signal of continued expansion.
And that was led by services.
It's exactly. Driven heavily by strength in services. France's PMI even nudged back toward neutral at 49.9, and consumer confidence stayed at an 8-month high.
So Europe's own economic engine is actually holding up better than people feared. Recession concerns are easing. But the markets just couldn't decouple from that U.S. tech repricing.
They couldn't. Now, turning to the UK, they finally got some good news on inflation. Headline CPI eased to 3.6%, which is the lowest it's been in 4 months. That should have spurred some optimism, that the Bank of England could finally take a pause.
But the policymakers are pushing back hard. I saw the comments from Hugh Pill, their chief economist. He basically signaled that even with the CPI relief, wage pressures are still totally inconsistent with cutting rates anytime soon.
Exactly. So you have that global risk-off dynamic plus this hawkish pushback from the BOE, and it just prevented European markets from capitalizing on their own good news. They were just collateral damage in the tech correction.
All right, let's head over to Asia. And here we have two very different but equally challenging stories in Japan and China. Let's start with Japan. The Nikkei fell sharply, down 3.48%. And that was mostly on that same global tech weakness.
But Japan's response was a massive fiscal stimulus. Tokyo unveiled a huge $21.3 trillion package. That's about $135 billion. And this is important. It's not just generalized stimulus. They are explicitly targeting AI development, shipbuilding, and also providing targeted household relief.
That sounds incredibly aggressive, a real attempt to spur some strategic long-term growth. But here's the complication, right?
Yeah.
That level of spending immediately raises debt concerns. And that pushed the yen weaker all the way to 156.7 per dollar. And at the same time, core CPI is still sticky at 3.0%.
It's the constant trade-off. This stimulus is a strategic play, an industrial policy move. You're aiming to compete in sectors like AI against rivals like China and South Korea. But the market, in the short term, sees the debt and the inflation risk, and the yen is reflecting that concern.
Okay, now let's turn to China, where the market weakness was just far more severe. Shanghai Composite down 3.90%. The Hang Seng plummeted 5.09%. They felt the global tech softness, sure, but the real issue there is that persistent structural headwind, the property sector.
October saw the fastest drop in new home prices in a year. The slump is deepening. We're now hearing reports, whispers of a big policy response, things like nationwide mortgage subsidies, tax rebates, that kind of thing. But the problem now is systemic. It's extending far beyond just the developers.
You mentioned Fitch's warning on this. That was pretty sobering. They said they expect bank asset quality to keep deteriorating well into 2026. What does that actually mean for someone listening globally?
It means the capital buffers of Chinese banks are being eroded by bad loans, mostly from the property sector. And when a bank's asset quality goes down, it has to get much, much tighter with its lending. That restricts credit across the entire economy. It means less business activity, lower demand, and crucially for the rest of the world, less demand for commodities, for energy, for machinery. It creates a legitimate global drag. The takeaway is that China's headwinds are deep, and these short-term fixes are really struggling to stabilize sentiment.
So we've reviewed the damage. Now let's look ahead to the trading week. And it's going to be a bit choppy, complicated by the Thanksgiving holiday in the U.S. So volatility could stay high just because thin holiday liquidity can really amplify any moves.
Right. And the data schedule is packed, especially in the U.S. on Tuesday and Wednesday. We need to be laser focused on retail sales, the Consumer Confidence Index, and specifically the Producer Price Index, or PPI.
Let's pause on PPI. You said that one is crucial. Why?
We watch PPI like a hawk because it captures input costs for businesses. It's the wholesale inflation they face before it gets passed on to you as a consumer. So a hot PPI reading on Wednesday would immediately contradict that whole dovish pivot the market just priced in. You would force another violent reevaluation of those rate cut expectations.
And just a quick warning for everyone listening. Due to a prior government shutdown, there's still a chance of delays in some of these U.S. releases. We're talking business inventories, PPI, durable goods, jobless claims. You need to verify the release times because the reactions could get really compressed.
And across the pond, the focus is also squarely on inflation. Friday's preliminary inflation data from France, Germany, and Italy will be absolutely crucial. That flash data is what will set the tone for the ECB's December meeting.
So it dictates the narrative for early next year. And globally, we'll also be watching for any actual signals on China's property policy. Will those subsidies materialize? And in Japan, the fiscal rollout and its effect on the yen will continue to influence global FX sentiment.
All right, now for the 5 reasons why the market entered this skeptical phase and why we think volatility is going to stay high, this is your critical watch list. It outlines the cascade effects from the risks we've been talking about.
Let's start with the one that triggered this whole thing. Risk number 1. The AI valuation reset accelerates. This is the big one. If skepticism about future cash flows keeps growing, it matters hugely because megacaps drive index performance. You need to watch for any sustained softening in tech and especially any signs of analysts starting to downgrade those long-term earnings forecasts. A negative revision cycle there will spill over.
Risk number 2, U.S. rate cut expectations swing again. We saw that probability jump from 30% over 70% this week. That fueled a big Treasury rally. The risk is a massive reversal. If Wednesday's PPI report comes in hot, or if Fed speakers push back hard, that entire rally in bonds could be unwound instantly. This is where people could get burned by front-running the Fed.
Risk 3, a European inflation surprise. Like we said, Friday's preliminary data from France, Germany, and Italy is pivotal for the ECB. The risk is reacceleration. If that headline CPI ticks back up, it undermines the whole case for easing next year. It forces the ECB to hold tight. That would push European bond yields up and could strengthen the euro, making their exports less competitive.
Risk 4. China property stress intensifies. This is the biggest systemic risk out there, not just for China, but for all emerging markets. If home prices keep falling faster, the uncertainty just grows. It leads to more defaults, threatening those bank balance sheets we talked about. A deeper decline means less credit, which means a profound drag on global growth. We're watching credit market signals on this, not just the headlines.
And finally, risk number 5. Japan's fiscal push pressures the yen. That huge stimulus package, while good for long-term growth, is debt-financed. It acts like a massive monetary easing signal. The risk is a rapid slide in the yen. When the yen weakens that sharply, it messes with global carry trades. And a sudden drop could trigger a huge unwinding of those trades, causing volatility across EM currencies and global asset flows. We're watching USD-JPY very closely for any signs of intervention.
So, to wrap up this deep dive, the evidence is pretty overwhelming. Global markets have definitively entered a more skeptical phase. It's driven by these very specific valuation concerns and a lot of macro uncertainty. The balance of risks, it really points toward continued choppiness, which will only be amplified by thin holiday trading.
And for you, the key takeaway here is to recognize this tension between policy and pricing. So if that AI sentiment continues to sour, if that valuation reset accelerates, does the market's perceived dovishness from the Fed, that 72% rate cut expectation, does that provide a strong enough floor? Or is the structural risk now rooted in China, that deep property downturn, just too profound for any short-term policy fixes? Does that mean we face a bigger global drag?
That is the central question you should be mulling over as you navigate this holiday-shortened trading week.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.